Hey everyone, Tom here. Today we're going to be talking about my thoughts on the S&P 500 technical analysis, as well as the Nasdaq and the week ahead news for the stock market. Stay tuned. So before we proceed with our top-down approach on the S&P 500 for the week ahead, breaking down each time frame and some potential opportunities that you might have, I wanted to talk about sentiment in the market right now, and more importantly, FOMO in the market right now, or the fear of missing out. So here we have SPAQ, a Spartan Energy Acquisition Company, and take a look at the movement in the Robinhood users this week. And this is actually becoming a trackable stat that's very important. So we had at the beginning of the week around 655 tracked users holding this particular share. And by the end of the week, we had 40,772 users holding this share. If we take a look at the change in the price, it went from $10.77 all the way up to $18.46 and then closed the week at $16.68. This is actually happening for a whole bunch of shares right now in the stock market, with a lot of retail herd jumping into these shares. And NIO, Nikola, Tesla, all of these car companies, electric car companies, are going crazy. And that has actually caused Elon Musk to now overtake this year. Yes, he has overtaken Warren Buffett in total net worth. The thing that's even crazier about this is Warren Buffett's about to go out of the top 10 richest people in the world. I cannot think of a time that Warren Buffett wasn't in the top 10. So we are seeing some big drastic changes. But why I bring this up is because if you're trading the stock market right now, I think you need to have alerts in terms of stop losses. And more importantly, if you're trading heavily moving shares, you need to have a plan. So make sure you have alerts, make sure you have a plan. And if you like having a plan and having alerts, make sure to follow this channel as we talk all the time about key levels, key areas in terms of technical analysis, and we help to educate you about those types of things. So before we get into the S&P 500 technical analysis, let's just quickly talk about that Fed balance sheet news. So the Fed balance sheet is below 7 trillion. As we know, the Fed underpins kind of the market right now. It underpins sentiment, and it's part of the reason why some of those shares are just going crazy right now. So the balance sheet is below 7 trillion and repo is dropped to 0 for the first time since September. It's pretty important. It basically shows that there's a lot of liquidity going around. And if we take a look at the balance sheet, we can see that steep rise when they began all of the programs back in March. What's happened since then is we hit kind of that peak of $7.168 trillion. And then each week it's steadily gone down. And we're now sitting at $6.92 trillion. And something you want to watch every week to see what the Fed are doing. In my opinion, it's basically the Fed also putting the tap on things, just saying, okay, we need this to cool down a bit. We're pretty happy with what we've done. Maybe we've overstepped and we need to make sure that the market tries to come into some type of balance because it won't want to be supporting it the whole time. So let's go into the top-down approach that we like to do on this channel. The first thing we do is we always check the monthly. Now, whether you're trading a 15-minute chart or you're trading a 1-hour chart or you're trading a 4-hour chart, every week, you need to do this type of analysis on your key pairs, whether it's Forex, whether it's S&P 500, or it's even a stock. So here we have the body closes, and we've just got a support driven through this 2500 zone. The reason we want this is because look how the monthly body closed. While the wicks got below, there hasn't been a body close below this zone. And that is very, very important when it comes to what we're doing in terms of technical analysis. We know this is a super key zone to be watching on the monthly. From the peak point, there's not too much to talk about except for, of course, we had that shooting star before the crisis, and then we had the fake out that happened after that over here, and then it crashed through. So remember, the stock market loves faking out. It loves making slightly higher highs and then coming down and then giving you the dip, or potentially everything then becomes a problem. So from the monthly perspective, nothing too much to note this week. When we jump down to the weekly, I just want to talk about the MACD indicator, and this is the MT4 MACD indicator for trading views. So if you want to check it out after this video, you certainly can. I use this indicator quite a lot to work out divergence in the market. And the reason that I want to do this is because this MACD indicator is just a lot simpler to look at, and it's worked well for me in the past. In terms of one of the key things that I was looking at before this crisis, I actually wanted to see the MACD go from the negative to the positive, and that was going to be one of my buy signals. Now, I don't use it as the only buy signal, but I certainly use it as a strong bottom is in the market. If you ever watched my video that I did on that, which I'll link above, basically I was talking about how the tech bust and the GFC gave a strong signal for that. But this time it's not going to be as good a signal because we didn't see a nice deep kind of normal 9 to 18 month crash, which you usually see in the markets. The Fed, of course, picked it back up. Here is what we're looking at. So let's take a look at this with everybody right now. Well, the one thing that is sure is we're on the S&P 500 right now, and that is the real market. So the market close, not the futures. Make sure you do your weekly analysis on the real market. It's a top tip that I think everyone should listen to. 3,000 is clearly a support, and around this kind of 3,200 level, notice how on the weekly we have not seen a close. And this is the weekly, important. 3,000 and 3,200 have not been breached each way from a candle close perspective. So the commitment of the buyers or sellers has not been able to get below this zone. We're clearly in some form of channel right now where we're stuck in a range, and that's partially due to the Fed kind of underpinning the market, but then also taking away some of the liquidity currently. And we've got that 20-50 cross. So the red line here is the 20 EMA, the blue line is the 50 EMA. And part of the reason this support's held so well is these moving averages act as what we call dynamic support. So they act as further support to the already key psychological 3,000 and everything else. So that's why whenever it comes down to these types of zones, it's finding a lot of support. But on top of that, the Fed knows this. So they're really trapping these levels. They're making sure that certain levels are held with key announcements at those times. And we've covered those a lot on this channel. So we've got these two levels. And I think that's probably a good way of trapping the market for now. We do have a bit of an engulfing candle here, but nothing really to note. And I think it's worthwhile then going down to the daily candles. Let's do this right now and talk about the key levels. Well, one thing is I'll bring this line down here, and I just wanted to mention this. So we've talked about how 3150 is key resistance and key support. Now, the futures did go through this level. So they did go through this level at one point, but notice where the closes happened. So the futures in the real market got under the 3150, but then it was picked up quickly by buyers of the mini dip, we'll call it, and they closed the candle constantly above this zone. It goes back to what I'm always saying on this channel. Confirmation is key to every single one of you, and make sure that you see everything locked in time, as in the candle is closed underneath that zone. So we're unable to do so on the daily, arguably one of the most important time frames, and we've closed above this zone and we're at 3185 ready for the open on Monday. So where else are we looking at? Well, we've got this resistance over here to the left, and this is higher than what we saw on the weekly. So if we have a look and we draw our line across, what we'll notice is that this is at the 3240. So what I would set alerts for is I'd set an alert for the 3240, and I would also set an alert obviously for below 3000, and you'd probably want to even be setting alerts for the 3150 and seeing how the market interacts with this zone, because quite easily the market will come down, close below this 20 moving average, and then all of a sudden it opens a potential short trade for you during the week to take it to the short side and then maybe take it back down into this 30-40 zone. So that's one option. The other option is if we set these key alerts, let's say it goes up and it breaks past this 3240, what we'd usually expect is role reversal, where the market closes above 3240, it then confirms, as in the confirmation is that the market candle closes above on the daily, and then it comes back down, it tests this level, and then at this level we might see on the smaller time frames maybe a hammer. We might see on the smaller time frames possibly an engulfing candle, and all of these are bull signals for us to get in. So you don't need to be part of the FOMO on the breakout. What you need to do is you need to be patient as a trader or an investor and wait for the key role reversal areas. Notice how even over here, it's a great example. Look over here. So the breakout happens and a lot of people were getting super FOMO. The sentiment was very bullish at this point. Then we get that big Wall Street dip, and notice how over here, the previous resistance held and became support and allowed buyers to get back into the market at a much fairer price than it was at this point. Now, of course, the market's gravitating up, but the point is that when something breaks, it often comes back and tests that level. So don't suffer from FOMO. On this channel, we're all about trying to keep our confidence up and wait for the key zones and take those key zones and stay in the game for as long as possible, because you want to be a trader and investor for life, not just for a couple of months. So there are key levels: 3150 again, 3240, and 3000. We want to set all of those as alerts and then watch the market's interaction with those zones. The other thing I want to do is I want to go back to the weekly, and I want to talk about these confirmation closes in terms of the weekly in the channel. So if we take the distance of the 3000 to the 3200, what you'll notice is if this was to close above, look at where the confirmation is. So the confirmation is basically right up at that 3400, so it's a 200-point channel, and we're looking for previous resistance to be the take profit of this type of trade. So the weekly traders will be targeting this level if this level is breached, the 3200 is breached on the weekly. Very important, because when you see a pattern confirming at a previous point of resistance, what this is telling us as traders is it's basically saying this is a self-fulfilling prophecy. The market knows that it wants to get there, it knows it wants to get to the high, and what you want to do is you want to be like taking your profit slightly earlier. So you want to be like, I know it should get here, but I want to take it around 80% of what I expect, and I'm going to be the smart person that gets out. So I'm not the one where Wall Street goes, yes, 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 yes. No, 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 no. That kind of thing. You don't want to be there left holding the bag. And that goes for a lot of those shares that are going crazy that we talked about at the start of this video. So the weekly, monthly, and daily present as a picture. When we go down to the 4 hour, we can start to see even more of what is been happening. So we can start to see more of the price action towards these zones, more of what the market is doing. And again, the 3150 is key. Even the body closes on the 4 hour of the real market, notice this 4 hour, are above this zone. So what does this mean if the market's to turn and we see a body close underneath this zone? Well, firstly, the 20 will have broken, but the zone will have got a confirmation close underneath that 3140, 3150 zone. That pretty much signals further selling. So what you'd want to do is you'd want to wait for it to come down. It will then generally come back up. It will test this area as a point of roll reversal. And then you want to wait for a change of trend on the smaller time frame towards the short. Now, it may seem like, why do we have to wait for that much confirmation? You might say, Tom, why the hell am I waiting for that? I don't want to wait for that. Come on. That's stupid. But you do this because the more confirmation you have, remember, if you have 3 to 6 reasons to be in a trade, that is much better. So what we'll have here is we'll have the confirmation close below, we'd have the roll reversal test up above, and we'd have the change of trend and possibly even maybe a shooting star, maybe an engulfing candle on that time frame. Who knows at this point? So if we have all of those reasons, we've got a lot stronger case to say, okay, the market is in our favor. The bears have controlled the market right now, and we expect it to gravitate towards the next zone, which is down here at the 3080, and then possibly even back down into the 3000 3020 zone. So that's what we want to be doing. That's how we want to be doing it. And that's some of the key zones that we're looking at right now in the market. I also wanted to point out this MACD because, of course, we've got strong MACD divergence, even in terms of when it reaches these 3230 highs. So this is what we call Class B MACD divergence, where basically the MACD is going to be a lot higher over here than it will be here. There's almost no chance that by the time this gets to this zone, that the MACD will be higher than it was over on this left-hand side. Now, if we saw something like that occur, would that be strong enough? It isn't strong enough reason to short alone. MACD divergence is great, but remember we were talking about MACD at the start of this video, and we were talking about how it's sometimes not the best indicator. It's a case, and it's one reason, but we need lots of reasons to place our hard-earned money in the market. So from the S&P 500 standpoint, you will see things like that. You've even got this kind of leg opportunity where now we're seeing consolidation here and it might go the same distance. That would pretty much just put us back into the previous highs, and everything really revolves around breaks of new highs this week or failures at this level. So you'd be wanting to set alerts for this 3230, 3220 area. You'd basically be patient and wait for that unless you want to trade it up. And unless it gets above this zone or below this zone here, you're really stuck in a range. When it goes out of that range, you can trade it to the next range. That's what we want to be doing generally. So I thought I'd just quickly bring up this Nasdaq and again just show you how divergence is at play, but it doesn't mean that we are going to trade it short. So here we have a new high, no doubt, on the Nasdaq. We're reaching towards that 11,000, which we were talking about on this channel, and we said that's most likely case scenario when it broke past the 10,000 for the second time. And effectively, we've got that divergence here where the RSI is having a higher point over here than it is during this price point high over here. This is what we call Class A bearish divergence. Basically, that's what we're seeing. Is this strong enough reason to sell it? Absolutely not. The trend is very strongly up. And until we at least see the 20 moving average here be broken below, I would not be shorting against this type of index. We have incredible strong FOMO in the Nasdaq, and we'll be talking about that later on this week. Regarding news, there's quite a lot of different news. We've got the federal budget this week in terms of US news. We've got a whole bunch of different kind of smaller bits of news coming out. The weekly initial jobless claims as usual, the Philly Fed index, and just a few things like housing and building permits. So there's a bit of economic news this week. We'll see how that ends up interfering in the markets, and we'll see whether it's good or bad. In terms of other bits of news, we've got Bank of England coming out in terms of Gov Bailey speaking. We've also got the Bank of Japan monetary policy statement that can affect markets partially. Bank of Canada in terms of monetary policy as well, and some employment changes for the Aussie, as well as some monetary policy statements from the Euro. So quite a lot of information coming out this week, but a lot of it isn't to do with the US, so we wouldn't expect it to move the markets too much. If you've enjoyed this video today, make sure to subscribe, hit that bell, and we'll see you in tomorrow's video. And by the way, we'll be doing some live trading over the next couple of weeks, as in we'll come in and actually have a look at the market opens. So if you're all about that, make sure you post in the comments down below and let me know what you'd like to see and some of the pairs you'd like me to cover. Thanks everybody, have a safe weekend, and we'll see you in the next video. Bye.